So the first up is the panel, the next wave of alternative lending, strategy, stability, and growth. We have our moderator, Katarina Veloz, Vice President and Chief Credit Officer, Wealth One Bank. Our panelists are Philip Beer, Business Development Manager, Community Trust, Susan Thomas, Vice President, Sales, Haven Tree Bank, Geeta Cartwright, Business Development Manager, GTA West and Atlantic Canada, MCAN Financial, Joe Rosati, Vice President, IC Savings, Isabel Adlin, Director, Regional Sales, First National Financial.
Welcome, everyone. I'm thrilled to be here with my colleagues to explore alternative lending. With that, we've got some great questions, and we'll get started. Question number one. So in light of today's uncertain economic conditions, what trends or new products are you seeing emerge in the alternative lending space?
Firstly, thank you. Thanks to being on the panel. Thanks to everybody that's here and to the nature of the industry that we're in and the competition that exists. Obviously, there's been an increase in a reliance of alternative lenders. We have the ability to offer flexible options beyond traditional prime or bank offerings. No doubt there's a combination of economic pressures, policy shifts, and demographic changes in the alternative space. But I might leave you with this thought first. What's changing at the most rapid pace is actually the Canadian borrower. It's changed. We've seen continuing involvement and actually borrowers that are changing. Borrowers have changed. Flexible learning, entrepreneurship, social media influencers, have a car, don't have a car, co-sign debts, thinking about buying up every 5 years. That's old thinking mentality. I said Canadians are now buying their forever homes and want to stay. So what we're seeing is a trend in extended ratios, without a doubt, and looking to buy up sooner. Underwriting continues to evolve with a watch policy on accommodating urban, small community, car, light, gig, or self-employed and newcomer households, all of which are a bigger slice of the demand. Lenders are using alternative data, utilities, rent, mobile phones to access creditworthiness. With so many mortgages renewing in 25 and 26, higher rates, alternative lenders are leading into cash flow and capacity to pay underwriter. Consumers are adopting and considering lenders with extended amortizations and flexible lending solutions. Recent trends are obviously a shift toward variable, shorter-term mortgages, equity release products with individuals staying in their houses longer. And what we see is probably the more common trend of all of this is that many more brokers have entered into this space.
Can I disagree with you?
Absolutely.
Just on the term comment, I think, thank you, Phil. Those were some excellent points. But the one sort of trend that I think we see a lot of right now is longer terms, but also, especially in the alternative space, it used to be that you'd get a bruised credit client, you do a workout situation, and in the year, you'd be able to transfer them back to the A world. I do believe we're seeing a lot longer workout situations, but the trend that we're seeing is brokers are actually selling longer terms than we'd ever seen before on, say, 2, 3, and 5-year terms on alternative business.
We've always seen a healthy mix between 1, 2, and 3 year. In fact, when rates did spike up, the majority of the deals that we did were in the 1-year term. But now we've seen that settle again. It's really 33% in the 1, 2, and 3 year. I agree with Phil. The alternative space lenders has exploded in the last few years. As you could see in the room next door, just the amount of alternative lenders that have come into this space. And for reasons as Phil has said, it's affordability, obviously, regulation, or making the box tighter. Strategies I'm seeing brokers, I'm seeing more and more brokers using reverse mortgages as a strategy, which I think is wonderful, but it's indicative of the consumer out there today and the challenges that they're experiencing. So wonderful to see all the lenders in this. I've been doing this for 40 years, and I'll tell you, in the 40 years that I've been doing this, I've never seen a period where mortgage brokers are more needed today than they've ever been needed, just to navigate through this space, and brokers just helping them out. And hopefully, at the end of the term, whether that client is with a private or an alternative, hopefully they can be graduated to a prime lend.
Great, thank you. Great insights. Joel, we'll stick with you since you're on a roll here. How can brokers strengthen long-term partnerships with alt lenders when borrowers are facing tight credit and shifting affordability challenges?
Strengthening relationships with lenders, I would think that number one, it's got to start with efficiency. You want to be efficient with your lender. We want to be efficient with the borrower as well. So in doing that, you really need to understand the lender's policies. What is their risk appetite? What are their guidelines? What will they do? Ask for lender presentations. I do lender presentations all the time. I would say lean on your BDN, your underwriter, your dedicated underwriter, if you have one, just to get a good understanding of what it is they do and what it is that they won't do. I would encourage you to, when you've got a deal, pick up the phone, send an email, send a text to that underwriter, to that business development manager. Discuss the deal with them up front. Does it fit? Before you send it in, just so that we remain efficient. Secondly, notes. I can't express enough how important notes are when you're sending in the deal. Tell us about the deal. As alternative lenders, we're a story lender. We want to know what the story is. Why are they going alternative? Is it affordability, meaning income? Is it credit issue? Those are important things for us to know when the deal comes in. And of course, suitability. We're both regulated by the same regulator. So suitability is something that they're looking for. It's right at the top of their list. And when you send us the notes, we use those notes to keep in our file, as you obviously are keeping in your file. Just, is this product suitable for the client? Is the rate suitable for them? Is the lender suitable for them? Have we done the right thing for that borrower? At IC Savings, when you send us a mortgage and it comes to the end of the term of that mortgage, if you pay us out to take that borrower to a bank or a prime lender, we feel like we've done our job. We've all done our job. So that is really, really important. So that's how I would say you should be strengthening your relationship. And the last thing I would say is be consistent with your volume. Whether you're funding 20, 30 deals a year with a lender, or you're only funding 3 or 4, be consistent with that volume. Because if you've done 3 or 4 deals with us this year, and then we don't hear from you for 2 years, and then you call us about a deal, we're really starting our relationship again from the beginning. So those are my thoughts in regards to building strong relationships with your lenders.
Perfect.
I think I would just only add to Joe's point about be consistent, but do more next year.
Yes. And every once in a while, buy lunch.
Susan, do you have anything that you'd like to?
I do. First of all, Phil and I were talking at the back of the room, said we were going to spar a little bit to make this interesting. You didn't take the bait on the first question, Phil. I don't know. I really agree with a lot of what Joe spoke about. This is a relationship business. You need to understand your client and have a relationship with them. But you also need to understand your lender and have that relationship. It's a two-way street. When we get a deal in, there's a lot of questions. So have you answered them? Do you have detailed loan notes? Are you finding the right solutions? Have you gone out and sourced the lenders that will provide you the right solutions? Things like right now with the affordability, Haven Tree Bank does second mortgages, principal and interest, and it is coterminous, meaning if you've got somebody that's got a first mortgage, we're going to be able to term it so that it works together. Knowing a tidbit like that, and each one of us on this stage has our unique value propositions. Knowing who does what is very important, but also so is the relationship. So I would say make sure you're getting to know, pick up the phone. Joe's right. Both of us have been in this industry for a very long time. probably one of the most underused tools out there. When an escalation comes to my desk, a lot of times it didn't necessarily need to be there. It could have been mitigated early by simply giving the underwriter the full story to begin with. So, we should hopefully we'll let you guys join in here.
No, I totally agree. I think that shopping a deal is probably a detriment to all of you, essentially. Like, you're ruining your relationship with your lenders, and that's really important, is coming to that understanding of what a lender has to offer. So I totally mimic what Susan and Joe has to say.
Okay, so I'm going to take a little bit of a different vein on this. And of course, I've been in this industry a really long time too, and I'm clearly using cue cards. Everyone's using their phones. So that ages me a tiny bit. But I would say when it comes to being curious about your lenders, I agree with that. Everybody on this panel is here to have you be successful. Everybody in that room, everybody that's set up a booth, everyone that's here, they're genuinely here for your success. And our research has shown that brokers are now working with less lenders. So you're tightening that group of lenders because you want to make those relationships a bit more solid. That's wonderful because it helps with efficiencies. It helps with they get to know your business. But be curious about other lenders. The A space is moving into the B space. That's not a secret, right? So you need to keep those options open with other lenders that are there. So please, when you're walking around today, don't ask, why should I choose you as a lender? Ask, how can you fit into my business? Right? How can we work together? Those are the questions that we can't wait to answer for you. And then, of course, when it comes to your clients, Joe talked about notes. We talked about the quality of the deal. So important. The last thing we want is more government intervention. Because guess what? When the deals aren't clean, when we don't get good books of business, guess who steps in and tries to help us out with that? So that would be how I would say to...
I would say too, old school, the 5 C's of credit.
Yeah.
Put that right in your loan notes.
Yeah.
Make sure it's very clear.
Absolutely.
Yeah. Go back to basics.
Write with paper. It's okay. Don't worry. Use paper.
That's great. Lots of great tips for the broker's toolkit.
Can I? No, that's fine. If I could just jump in, I think one thing that's been talked about that is sort of been a little bit, and Susan to talk about back and forth, we're seeing more shorter term, and no matter where you are, I think less existing clients graduate into the A space, so it's less due than more. But I think one thing to highlight is that you need to set realistic expectation with the borrowers. I'm sure all of us see privates up in 8 days, 9 days. We received the application yesterday, right? We need this group. And my commentary around new entrants into the space, yes, obviously by the size of the people in the room in the lending community, I'm referring to with the shift in A lending, there are more agents and brokers in this space than there was a year ago and 2 years ago. So for all of you that have specialized in this space, there are more taking opportunities to learn. So if you're setting the expectation with the borrower, setting the expectation with the referral sources that alternative lending is always assumed to be fast, quick, in and out the door and done, that has changed. Set the expectations with the referral sources, the borrowers, that I need my time, I need to do my due diligence. Underwriting has changed. It is a cash flow business. There are looking at alternative sources. That is not the same as on an A deal, looking at a 750 beacon score with A1 repayment and job letter and pay stub. So my point, really work on setting expectations. And I think in the end, you will do a lot for yourself and the referral sources that are sending you business.
Well, and further to Phil's point, especially on business for self, we are, show of hands, who has to now look at AML? I mean, you're all working with FinTrack now, you're doing your AML. We've been doing this for years, but it is getting more and more stringent, the protocol behind it. So if you've got something like a get to know your business form, don't fill that out because you think you know the answers for your clients. Make sure you're having a conversation and make sure you're explaining to your clients why you need that information. We need to understand that business. We also need to understand the viability of the income that we're using. So we just have to make sure that we mitigate risk. And that's that partnership with the brokers. We work together to help you. We're not up looking for ways to decline your deal. We're looking at ways to help your clients build long-term solutions.
Important also to Phil's point, if it's taken 3, 4, 5 days to approve a deal, and that's pretty normal these days, that's why it's important to understand what that lender's risk tolerance is and having that conversation up front before you send in the deal. Nobody wants 4 or 5 days to go by just to get a decline. So that's why it's important to understand the lender's guidelines, risk tolerance levels, and have that conversation up front. What's the probability that this type of deal is going to get approved?
I think we're all happy, that's very loud, I apologize, that condition of finances have returned to the marketplace, right? If we think back to those days that, pressure was on and people were working extended. So when I talk about, building the relationship and setting expectations with the borrowers, take your BDM into a realtor office. Realtors are a part of this financial journey, no matter what way you cut it. Some choose, some brokers do, some brokers don't. But get in and speak about the opportunities that are there, because what we are seeing is the definition of an alternative client is not necessarily bruised credit, self-employed stated. It is now individuals that have great credit, have a substantial financial net worth, have great jobs, want a smoother path of least resistance, and want to push the limits on their borrowing capacity. So that has changed, but setting the expectations with your realtors that the condition of finance, the appraisals are important in this financial journey. So give yourself the time not to have your back against the wall and putting pressure on yourself and the client for what inevitably could be a poor journey for your client.
Awesome. Lots of great tips on strengthening long-term relationships. Okay, let's move on to our next question. Given current economic volatility, what does true stability look like for alternative lenders, and how are you balancing risk with opportunity? Hida?
Yeah, I'll start with that one for sure. When I saw that question, I thought, wow, what does true stability actually look like, right? This is not the first time in history that we are running into economic uncertainty, right? Joe's been around for 40 years. Many of us, you're a lot younger, you're probably not, but many of us have been around a long time, right? And we've seen those things that have come up that have created all sorts of economic uncertainty. So what kind of happened then? Well, of course, the government jumps in, right? They want to help with social programs, but lenders have become pretty creative, right? And our service partners and insurers, right? The HELOC got introduced all those years ago. We started making it easier for BFS, albeit we have a bit more due diligence to do now. We made it easier for new Canadians. We launched 30-year AMs, 35-year AMs, right? So we did all these things to help. So now what's going on, right? We've got credit at its absolute maximum for clients. In fact, 1.4 million Canadians missed a credit payment in the second quarter of this year. That's huge. So how do we help with that? And I think how we try to find some stability in that is flexible underwriting. And what I mean by that, I think of a couple of things, and these are the three that sort of stood out for me. One of them would be multi-generational homes, right, and families. That's increased 20% over the last 10 years, right? I was blessed to be able to live with my parents for a decade. And so I think more and more families are doing that. So how do we use the income within those families to help make those deals work, right? I would also think of... we know people are leaving urban areas, right? They've got to move to different areas to make the affordability work. So as lenders, we need to be more open and embrace different lending areas. We have to be open to maybe places that aren't totally urban, a little more, not remote necessarily, but maybe a little bit more, rural, and embrace those. And then there's income. We're very good at alternative different types of income streams, right? We've become pretty comfortable with that. But now people are taking on other gigs, right? Little side gigs. My sister-in-law, for example, during the summer, she's a TA. She ended up doing I don't know what it's called, the groceries, where you pick up and you deliver groceries. And she did that. She loved it. It was on her own time, and she made a couple of extra dollars. We need to be comfortable with that, right? Another girlfriend of mine, she's she went to one of the colleges near her place and said, listen, I'm willing to facilitate or it's called invigilate, I think, is it called? When you moderate exams. Thank you, everybody. I haven't had coffee at all, so I just want to be very aware. Those are the types of little income streams that people are taking on to make ends meet. And we need to be comfortable with that and know that that income is kind of in the background. And then we mentioned a little bit, Susan, you mentioned talking about exit strategies. We've all talked about that. Being present for the life cycle of your client could not be more crucial, right? We talk about a CRM, that's not even just it. It's being with them through the beginning, it's going to take a little longer maybe to get them onto the A side. How do we get them from deep B to maybe A and help them? We really want them to be successful, have an exit strategy, and help them have strength in their financial plans and their goals.
I agree 100% with Geeta. As I said earlier, alternative lending space has exploded in the last few years, and they're addressing a lot of those issues that you've just talked about. Inconsistent income. Are there lenders out there that accept it? How do they accept it? What's their policy? This event here today, and you see the amount of vendors next door, all these alternative lenders that have come in have a different niche of what they will do. Get to know them. This is what today is for. Visit them, ask them what it is. Build a library in regards to what their policies are. Because tomorrow you might get a customer that might just fit perfect for that new lender that you've just been introduced to.
And I would say too, with every time you have uncertainty, there is always opportunity. Take a look at your database. Go back, figure out perhaps there's a segment, just as Geeta was saying, different times in people's lives where you could find some opportunity. I love the idea of a multi-generational home, but the other thing we're seeing a lot of too is people putting in rental suites. You know, if you need something like our improvements mortgage, for example, you could target your clients to say, hey, are you finding it a little bit more difficult? Are you considering this? And send out some information towards that, see what comes back. But really, you're sitting on a gold mine. So in uncertainty, the other thing you can do is simply pick up the phone. If you're scared, how do you think your clients are feeling right now? Just to have a reassurance to say, hey, just checking in. There's a lot going on in the economy right now. Do you have any questions? You'd be surprised how many deals you would get just by doing that alone.
And just to jump in, if I go back to the question, which is really how are we balancing risk with opportunity? And I agree with Geeta, obviously quickly expanding into underserved areas. The question becomes, is a 575 Beacon with extended ratios in downtown Toronto a better deal than 20 kilometers outside Cobourg where affordability is better, cash flow is better, and ratios are a little bit less? We obviously start to balance risk. How's that done? Through risk-based pricing, obviously, but recently, and you'll see things that come from ourselves, and this isn't a commercial for Community Trust in any way, but design products that change the denominator, right? Get a created focus. If you want to increase a certain segment of the business, and whether it's you want to be able to turn and roll over deals quicker and spend less time in stated, that's where we find opportunities to balance risk. And I think lastly, which Joe talked about a little bit earlier, is we need to identify the brokers that we want to deal with and the ones that we don't want to deal with. We can't be everything to everybody. There's not any lender here that can. And I think if we take that approach and we've done our part and the broker's done our part to give us a shot and you get an understanding, create niche, that's how we're balancing holistically the risk versus opportunity. Do I believe today that the product that's needed, I think the product that's needed 5 years from today in this space hasn't even been designed yet. The industry is evolving, right? We are always going to analyze risk and opportunity. And I agree with Geeta, getting into outlying areas and growing those capacities and provincial boundaries help us.
Isabel, looking ahead, where do you see the greatest growth opportunities in Canada's alt lending market? And how can brokers prepare their businesses now?
I would say, firstly, think beyond the mortgage. Think of different credit-related things that you can offer your client. So credit repair, financial coaching, possibly even some advice on real estate investing. Your clients aren't really coming there just for a loan, they're looking for a game plan. Also, if you're new in the alt space, don't be shy or scared to co-broker a few deals with an experienced broker. Learning from them, having hands-on, builds confidence, and then that way builds a relationship with your client. Business for self is huge in the alt space, and really understanding business income, their expenses, and how the business really truly operates helps you place that client with the right lender. Leverage your BDMs, as like everybody essentially talked about. It's huge. Be the subject matter expert to your clients and referral partners. You'll be astonished by how many times you'll see them and how many people they're going to refer to you. When you're having conversation with your client, try to drive the conversation from rate focus to solution based. Alt lending is all about problem solving, and that really helps you place a client with the right lender at the end of the day. First National, we offer a lot of education sessions, and it's nothing pertaining to our products. It's actually added value for you guys and what you're able to take back to your clients.
I think Isabel makes a good point, specifically in regards to self-employed individuals. We certainly see a lot of them, more and more of them are going into self-employed. Everybody has a different program in regards to how they qualify that income on the self-employed. So it's important to know, as Isabel said, really understanding how they make their income, how do their statements look, what do their bank account statements look like, really dive in, and then find the lender that can accept that income, accept that cash flow that's coming from the self-employed. It's a big part of our business. I mean, it's 55% of what we do at IC Savings is self-employed. And different lenders have different policies in regards to how they look at that income.
Great, thank you. So it looks like we do have some time, and I will open up the floor to audience questions.
Hello, everyone. Good morning. I have had lots of coffee. What I just don't see that B or any lender does well is divorce. Spousal support income. There's a ton of great divorce out there right now. You guys don't use enough of it, aside from Joe, who has the reset mortgage, which is a godsend for divorce clients who have tons of equity and are going to take over the home. Other than that, there's nothing out there that gives newly divorced people opportunities to, especially if they've been stay-at-home moms or stay-at-home dads or whatever. So that's one thing I'd love to see all the lenders consider in their space.
Haven Tree offers that. We will add
100% of the
we will add the alimony. We will add that to income. We also deduct child support. So again, it's a matter of knowing how your lenders work and what that entails. So we can.
But you don't take 100% of spousal as their only income. I haven't found one lender that does that.
You know what? That's an excellent question. My CEO's in the room, and I should know that off the top of my head. But let me verify. But we have a very unique value proposition on our.
That's just my support to all the B space.
Yeah.
Is that we're seeing a ton of divorce. 50-somethings are tired of, doing their thing with these losers, and they're off and gone. And sorry, 50-somethings, male and female, are done. And we're all going to be single and having an 80s party into our 90s. And some of them need mortgages when they're starting out, right? So
Just if I could jump in regards to that. One, stop by our booth, talk to your BDM. A couple of areas that we can. So we take alimony off income. One thing that I want to note is that if you have, what's better than being able to get both transactions, dealing with the solicitors, that if you have couples that are going through this, and we have a policy that allows with 6 months confirmation of a mortgage being paid by another party, we will take it out of the lending ratios. So imagine a situation where the departing spouse can't afford to buy because of their commitment to the existing residence. We have a policy that allows that to work. I've actually, in fact, talked to one of the brokers that sits in this space, only does these mortgages. and asked, is there a product here? So if you have lawyers that are playing nice in the sandbox during divorce, we have a solution for that. The other space that I'll talk about is we do have scenarios where if there is 100% capacity or 100% reliance on alimony or child support, we can entertain. Is loan to value going to be adjusted? 100%. So I assure you, stop by, say hello. I'm sure all of us have more intimate solutions that we can talk about, but there is a tremendous opportunity in that space. And in my region, I see a lot of it.
There's also the strength of the file, the loan to value, the credits. Like there's so many different things, and I know the credit is often affected in a marital split. But again, this is why in B lending, the story is so important. The biggest thing we want to know is, are we putting putting the client in a solution that is sustainable? So if we can mitigate some of that, that's really where that story comes in.
And apart from product, Sophie brings up a good point. This is about feedback, right? When I talked about chatting with your lenders, finding the gaps in your business, where are the gaps in the lender's business? We need to know that feedback too. When you have an opportunity like today, times when they ask for surveys, there's times when there's open forums, your voice really does matter. At MCAN, we have summits across the country and we take that very seriously. A lot of policy changes are made this way. Don't think that your voice doesn't matter, and asking these questions brings to light that maybe we need to look at different ways to enhance our business. So thank you for that question.
100%, Gita.
Thank you. So my question is towards the debt servicing ratio towards the file. I heard from whole panel, you as a lender doing your part by extending the ratios I think this is going to be a great place where you can play a major role instead of opening new areas in Ontario to lend. As we know, Canadian real estate has grew his value, right? Loans are double and triple. People have very different ways of, unique ways of income. Each individual in GTA right now is working 2-3 multiple things, have different source of incomes. So as broker and 17 year in this industry, as my first career and as my only career, the great help which lenders can do today is work towards GDS TDS ratio. Instead of giving 35 years ammo, 40-year ammo, are we really helping borrowers? We're bringing them in more debt. Secondly, when underwriting is declining a file on Alt-A, and I'm not talking about purchase, I'm talking about a demarket, existing loans. And if somebody is approaching to you and you're declining, you see they're paying private, 10%, very fine. Now, B space is like, oh, just because they're not 44-48, just because they're not 50-50, just because they're not 55-55, IC doesn't do the stress test, you do the stress test. You have 55, you have 60. Don't you think so? This is kind of, we have landed ourselves in a position where all we need to sit down and reintroduce the new policy on debt servicing ratio, which actually works for borrower. Thank you.
I think that, respectfully, I think there's a lot in that. So I'll answer it as best as I can, and if not, please stop by our booth if you feel that I haven't. So extended ratios, absolutely. We have a laundry list of solutions. Our non-conforming product, I'll touch on without getting into it, is for individuals as a tradesperson. An example, I make through the union X, but we know that there's cash opportunity on the side. Those are things that we can entertain without actually seeing the cash, but knowing. So we have a product that is very much, I want you to think of it this perspective, that if you did my deal and you had to explain to the regulator, to FSRA, why or what my capacity to pay is, that's the approach we have in our non-conforming product. That's as quick as I can say that with colleagues here. But there are solution-based lending. So we talk about ratios. I will counter or lob back or tennis ball with this. There is good debt and there's bad debt. And I think we would all agree. Bad debt is running up $100,000. Good debt is maybe buying beyond your capacity. The reasons that you're extending ratios at 60, 60, 70, 70, 75, 75, 85, 85. At the right loan to values, we have solutions for that. We also have the ability to take out TDS obligations that would be Emma and Alexa are my 3rd and 4th year university student daughters, that if I were to co-sign their loans and I can prove that they're on their way to financial independence, I can take that out of ratio. So what could be 70-70, I can mate FIC at 60/60. So there are lots of solution bases. And I think it's just really building an intimate relationship with your lender. And the last thing that I'll add to this, in all of this, choose the lenders that have access to equity, that aren't access to funding you can count on for funding, that are going to be there at renewal. We understand in the last 5 years, so much has changed. All of us have received calls from individuals where lenders are not renewing. That is extremely important when you're choosing who and where to place your deal.
I agree with Phil. Not all lenders are created equal. We are structured differently. Some of us are Schedule I banks. Some of us are monolines. It's our funding in the background that sometimes dictates what we can and cannot do. The best thing I could say is understand who your key lender partners are and really sit down with your underwriter, have a conversation. If it is extended ratios, hey, I'm like, we're all of us here are trying to mitigate risk, making sure that we're not putting the client in something they cannot afford. So if we're seeing high ratios, we need to understand the story, because technically on paper, they can't afford it. And you mentioned there might be other factors in there, other income. The more you can give your underwriters to verify and validate why this is a good solution for the client will help every single time. And we don't always get the whole story. So again, that's that partnership and understanding.
I agree. And there are a lot of lenders out there that have different policies, different guidelines, that have extended ratios. At IC Savings, we don't stress our mortgages as an example. But given the economy today, and we see it every day, unfortunately, there sometimes are borrowers out there that you just can't help. They're at the end of the road. And that's the advice they need to be given. And unfortunately, when they get to that point, the reason why they can't be helped is because the previous mortgage that was done, or even the previous mortgage before that, perhaps maybe shouldn't have been done. Now they're in a private, you say they make their payments, but did they make their payments, or have those payments been collected up front and now they're at the end of the term? So it is unfortunate. Those are hard conversations to have. But sometimes, as I see with some deals, the conversation should have been had a year or two earlier, and now they're at a point where they just can't be helped. And I know all of you have had that conversation with a client, and they're tough conversations to have.
Thanks, Mark. I think we have one other question here at the front.
Hi, good morning, everybody. I find that over COVID, a lot of people moved out of GTA. And so they bought these beautiful properties out there. Now interest rate changed. And so they cannot afford their mortgage. And we're trying to refinance them and pay all those debts that they piled up over the 5 years because they couldn't go on vacation. My challenge is lately, I find that lenders are shrinking their area of approval. How often does a lender look at their area of approval and determine, okay, maybe, it's been 3-4 years, we should expand this area because developments have increased over there. We used to have one subdivision. Well, guess what? We got 3 plazas, schools, and all that. So it is a resellable property, and you can accept it at 75% loan to value. I'm not asking for crazy numbers, but that's the challenge that I'm finding, that lenders have shrunk their area. And how do you review it? Do you go back and see those areas have been developed? So let's give them the lending.
At Haven Tree Bank, we recognize that. It's interesting you mentioned that, Tina, because we've gone and gone to partners to get very, very specific analytics and are able to, we're just in the midst of rolling out new lending areas. But the great thing with partnering with some of these firms is we're leveraging technology, and we're able to sort of look at this in a real-time basis so that we can go back and revisit on a regular basis to say, hey, this is in Oshawa. All of a sudden, this was a farmer's field in March, it is now a subdivision with everything you have. So being able to be versatile and to adapt, we've actually put in a whole new process. It's just in the process of being rolled out.
Just very quickly to jump in, we are not in shrinking mode in lending area, I would say, and I'm looking at Jason right here and hoping he's going to nod. We're absolutely pounding in growth mode into Atlantic Canada earlier this year, into the prairies. And I understand it's more a regional based question, but we are, I think it's safe to say we have one of the more aggressive lending areas. So if that's your piece, then stop by. But absolutely keep in mind, we have our InstaShare, we have AVM commonly, or GVS, what's commonly referred to in the industry. The appraisal's key. Right? Obviously, that appraisal dictates so much in our decision and our over underwriting. So using approved appraisers, we have a condensed list, using our partners through the AMC, all help in that scenario. But I assure you, we are not going backwards in lending area. We are growing.
So a selfish plug here, Wealth One does not have any restrictions, lending restrictions on geographics. We lend everywhere except for the province of Quebec. I think with that, we'll move to closing remarks. Maybe Susan, we'll start with you, some final remarks.
Wonderful. Thank you so much for moderating this, and thank you to my fellow panelists. And thank you to all of you. You're doing one of the greatest things you can do for your business, and that's investing time into your business, gaining knowledge. All of us are professionals in the Canadian mortgage industry, and we have to be diligent in learning new trends and finding out what is available so that we can provide solutions to our clients. This is just a great opportunity to get to know who's here and what they do differently. We're all here to help house Canadians, and we all have a variety of options.
As I said earlier, and to add on to what Susan said, mortgage broker market share is growing. It's growing accessibly, and it has in the last couple of years. As we've talked about today, borrowers need help, and they need your help. And they can't navigate this landscape without you because of the choices, because of the situations that they're in today. For many reasons, as you see every day when you talk to your clients. So I think this is a great opportunity for all the mortgage brokers in this room. And I just think that market share is going to continue to grow. When I got into this business, it was probably mortgage broker market share was 10%. It's north.
They also didn't do A lending.
It's north of 50% today. So congratulations to all of you. This is the opportunity, as I said, to find new lenders, find the different niches, because a lot of them come into this industry, grow that library, understand their products, and help out your clients as you do every day.
I think where the opportunity is for brokers leaving this room, build power teams, partners with your referral sources, get together, bring in experts. I think really one site is create microsites, landing pages for cash flow, refinances, whatever it may be. There are accreditations in the marketplace that exist, and their costs can range from $99 a month to $3,000 or $4,000. Invest in understanding cash flow lending, and that will take you often enough away from interest rate conversations and provide solution-based lending.
Thank you for joining us today. A big thanks to our panelists. They did a fantastic job. It's been a great conversation. And I hope you're leaving us with a few takeaways and some great ideas. Enjoy the rest of the summit. Thank you.